but this is a $20 gold coin. So 1900, well, if you told somebody someday that 1 ounce of gold is going to be trading at $2,000 on the spot market from 20, they would have told you were crazy. At this point, they are not accurate to the fundamental value at all, which I would gauge is somewhere around 15,000 or more globally. If it were the US, it'd be more than probably about 60,000, 70,000 an ounce, which I know sounds outrageous. As long as Wall Street can create lots and lots and lots of digital gold and silver, they can continue to suppress the price, because we all know a rising gold price is an indication of a failing currency, and that's what they don't want you to understand. They don't want you to own it, because once you take it in possession of it, it becomes invisible to them. Okay, so that's the first thing, but understand that when the public loses confidence, those overnight resets are when gold and silver will begin to go toward their true fundamental value, because they have to get the population's confidence back. And this garbage, the fiat money, has no intrinsic value, and it's only used in one place. So they take gold, that is the primary currency metal. Physical gold, physical silver is used in every single sector of the global economy. So it has the broadest base of functionality. And according to the Bank for International Settlements, is the only financial asset that runs zero counterparty risk. So you hold it, you own it. But because both gold and silver, it is used in medicine, electronics, the financial system, art, jewelry, food, space travel, and on and on and on. Every single industry of the global financial system. So every sector, not just the financial system, every single sector. So what does that do? That means that 100% of the time you have demand. And when you go in the physical world, there is a finite amount of it. Period. End of discussion. Can't print it. That's right. And they've tried to figure out how to recreate the qualities that both these metals have in the lab, and they have never been able to do that. Period. They have not been able to do that. So right now we're on a dual system, right? Where you've got the paper price of gold that people look on CNBC or Bloomberg or in the paper or whatever and says, oh, spot's at $2,001.39 or whatever. And silver spot is at $25 and change, whatever. But they can create as much gold and silver as they want. That does not exist.
Right.
But what have we seen with the premiums when you want to buy the physical? So we're seeing in that area, what'll happen is the premiums will get larger and larger as they are now, and will more accurately. At this point, they are not accurate to the fundamental value at all, which I would gauge is somewhere around 15,000 or more globally. If it were the US, it'd be more than probably about 60,000, 70,000 an ounce, which I know sounds outrageous, but this is a $20 gold coin. So 1900, well, if you told somebody someday that 1 ounce of gold is going to be trading at $2,000 on the spot market from 20, they would have told you were crazy. So not so crazy, because that's more reflective of its true demand and supply qualities. So there's lots of demand that's coming for both of these entities, but it will be more realistic to a true supply and demand economy. In 1913, there was $1 worth of purchasing power, and today there is barely more than 3 cents. So one of the big problems and why we can't kick the can down the road is because there's no more purchasing power to inflate away. The second reason is because the key tool that the central bankers have to regulate the rate and speed of inflation are interest rates. They're raising the rates only so they can lower them again And truthfully, they experimented with negative rates, and that didn't work, did it? What are they debating? Oh, maybe there'll be one more rate increase. Maybe they'll cut. Blah, 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 blah. It's all garbage. It's just window dressing. It doesn't matter. If they cut, well, that'll just speed up the inflation to a more noticeable level. Because guess what happened? Even though they were trying to run off their balance sheet, in other words, reduce their balance sheet that went from 800 billion in 2007 to 8.6 trillion just recently. So they tried to run it off very, very slowly, a little bit. In other words, sell those bonds, treasuries, and mortgage-backed securities. And boom, if you look at their balance sheet, up like a rocket ship again. Mm-hmm. So they can say, don't call this QE, like the Bank of England too, when they were doing all their money printing, buying the bonds because their treasury market was falling apart. Don't call it QE. Look, it rose by any other name. You know, you can call it whatever you want. They don't say confiscation, but isn't inflation a form of confiscation? By confiscating the value, the purchasing power value of your money and your work. And what's kept us in the position of the world reserve currency that enabled all of that was the petrodollar. And Saudi Arabia, I mean, first of all, it's OPEC plus. It was the plus. Russia is the plus, right? Mm-hmm. And they just completed a couple of deals, like 2 deals in China for their refineries, and have come out and said, well, we can accept any currency for our oil. It doesn't just have to be dollars. So if it doesn't just have to be dollars, then why do all those central banks need to continue to hold it? And did we not just show the world that if you don't do what we want through the SWIFT system, the global payment system, that we will, boom, cut you off? So our arrogance, our level of arrogance is absolutely incredible to me. But when we go to a CBDC, right, then, I mean, it used to be, look, when they go to the CBDC, people are going to think, oh, okay, they've solved it. But they haven't solved it. They have to get rid of all of the debt. They have to finish the transfer of wealth. The way that we are all going to know that they're truly at the end is when they put a component of gold in it, because that creates fiscal responsibility.